Ladies and gentlemen, good day and welcome to SBFC Finance Limited Q2 and H1 FY2026 earnings conference call, hosted by ICICI Securities Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Renish from ICICI Securities Limited. Thank you and over to you, sir.
Thank you, Ikra. Hi, good afternoon, everyone. Welcome to SBFC Finance Q2 FY2026 earnings call. On behalf of ICICI Securities, I would like to thank SBFC management team for giving us the opportunity to hold this call. Today, we have with us the entire top management team of SBFC, represented by Mr. Sindhu, Managing Director and CEO, Mr. Mahesh Dayani, Executive Director, Mr. Narayan, CFO, Mr. Sanket Agrawal, Chief Strategy Officer, and Mr. Rajiv Thakkar, Chief Risk Officer. I will now hand over the call to Mr. Singh for his opening remarks, and then we'll open the floor for Q&A. Over to you, sir.
Thank you, Renish, and good afternoon, everyone. The challenge of any business build, is that while one is building for the decades, one is accounting for in quarters. If I ask you what is your plan for the evening today, you are likely to be very specific. I'm going to watch a movie, a play, go to a party. If I ask you about next week, you may have something a little more general. The next quarter, details start to blur. The next year, you will probably say more directional thing, and the next decade, and we get into the territory of hope. Similar challenge a company faces when it looks ahead, a quarter, a decade, and a century. The challenge for any management is to get both the next decade and the next quarter right. At SBFC, when we look at how the most abused word in startup decks, called the total addressable market, the TAM, stands, we feel very bullish about the future. The total MSME book of loans between 500,000 to 3 million rupees, which is our target segment. The total book, complete, which includes banks, NBFCs, all kind of lenders, between 500,000 to 3 million rupees, is about 4 trillion rupees as we speak. And this has been growing at a CAGR of 24%, meaning it's doubling every 3 years. The best thing is, as far back as I look, these numbers have held, which means through peaks and troughs, through interest rates and delinquency cycles, the market growth has neither accelerated nor decelerated. And when one looks at the decade ahead, one can safely presume that the market will grow at a CAGR of 20%, and which means it will double in about 4 years. So from 4 trillion that it is right now, it will go to probably 8 trillion by 4 years from today. Now, as we know, growth cycles are produced by interest rate cycles. India right now has one of the lowest inflation volatility in the world. This produces a low interest rate volatility, which feeds into lower growth volatility. Even if you don't want to get too technical, let's just know this. It is not the quantum of the move, but the volatility that kills you. So a low growth volatility is a really good place to be. On top of this, India, in my view, is a long-term trend of low real interest rates. We have decidedly entered a cycle of low real interest rates. A low inflation interest rate growth volatility and a low real interest rate trend is music to a banker's ear. The long-term trend is for India, for India is very clear. It is up. In business, as in life, it is very critical to get the long-term trend right. While you may get the decade right, it would be posthumously for the management unless they get the quarters right. So when we look at the more immediate, we shift from the telescope to the microscope, and there is never any beauty one can find under a microscope. The near-term view is a chaotic bazaar with so much noise and cacophony that it gets very difficult to preserve your enthusiasm. To those of you who have followed our earnings call over the years, at the risk of becoming a I told you so expert, we had seen and called out a shorter-term trough in April 24. Post-COVID, Indian lenders had kept the bar open for too long, and alcohol and money both have unlimited demand if they are easy to get on credit. RBI was watching this too, and in the second half of fiscal 25, it read out the Riot Act on the unsecured lenders first, and then the microfinance sector next. We are in the business of lending loans that will need to get repaid every month over a long period of time. The business segment we lend to has uneven cash flows and operates in an undisciplined way. A few days back, the screen in our office displayed our live loan book rising in real time as we crossed the loans getting disbursed across 220 branches. I usually see this excitement when an important cricket final is underway to a nail-biting finish. A loud cheer and applause broke out as we crossed 10,000 crores of AUM. Now, on a lighter note, I know the knife that came out to cut the cake that's been wheeled in is on my throat too, for we can truly celebrate only when the monies come back. We are the only business that expects sales returns to happen. These high-yielding loans price in the incipient risk in them. Our job and raison d'etre is to price and manage this risk. Last quarter, in line with peers, we too had a large flow in our 1+ portfolio. The previous quarter, the June quarter. This quarter, while the tide hasn't fully stemmed, the intensity of the flow has calmed, and we are still very watchful, for we need to first stem the flow and then try to reverse it. There are a lot of numbers when a finance company puts out its results, but a first amongst equal, or the moral of the story, is return on equity. What is the return made by the shareholders who trusted us managing their money? We had constructed an ROA tree on the DuPont curve. The power plants, step up the voltage for long distance transmission and step it down to substations and finally delivering it to your home. And when you flick a switch, the bulb comes on. Reporting this ROE of 14% this quarter for all of us at SBFC is how Edison would have felt when his bulb came on in 1879. This damn thing is working moment. In finance, it is never so easy. We could arrive at this ROE by using a high leverage, and that isn't the ideal solution. So one has to ideally reach it on a very low leverage, which means that you need to deliver a high ROA. At north of 4.5%, we are achieving 14% ROE at a debt equity of under 2. I was looking at our first earnings call in September 23, where we had delivered an ROA of 3.8 and an ROE of 10.4. So happy to see that we have doubled our quarterly profits since then. That was just after our listing. We have ample capital, and as we build to reasonable leverage, it should have a salutary effect on our ROEs going forward. We have two tailwinds powering our climb. Incremental borrowing cost is down 80 basis points over the book cost at the beginning of this fiscal. Over time, this will keep feeding into the P&L. Cost of operations has come down 112 basis points since our IPO, and incremental benefits will keep feeding into the P&L. But as we make investments for growth at a reduced pace of reduction. I would also like to draw your attention to the headwind we face. Tough credit environment. Credit cost has gone up to 1.29%. Our PCR is at 46%, well above our stated intent to keep it north of 40%. And we do not take into account interest on NPAs. And we do not upfront any income to DA or any co-origination to reduce our future earnings volatility. I would want investors to know that while we are doing the best we can, we are solving a difficult problem, and the risks are evenly balanced. The yields on our business fairly compensate us for the elevated risk, and we won't sleep easy till the flow into 1+ is fully stemmed. What has changed over the years are the two risks that did not exist to this level earlier: political risk and climate risk. Karnataka is a classic case in point, where a superb portfolio till January 25 got rudely shaken up in 2 months, and this now is going to take several quarters to fix once it starts to flow. We remain cautiously optimistic about delivering a 5 to 7% quarter-on-quarter growth. Credit cost could, from this point, inch up 10 to 15 basis points before they peak out. We have further tightened our credit screens, stopped lending below 7 lakhs, and raised the gate of entry to a CIBIL of 700 at a minimum level. And we now watch out for banking behavior and over-levered customers in a more tighter way than we did before. We thank you for your trust, and with this I hand you over to Narayan, who understands numbers far better than I ever will.
Thank you, Asim. Hi, good afternoon. Our AUM as of September is 9938 crore, and as Asim said, we achieved 10,000 crore now, and this is with a growth of 29% on a YY basis and 6% on a QOQ basis. With 100% of our books secured by properties and gold, we have a very minor unsecured book left, which is hardly in terms of percentage. Our MSME AUM, which is 82% of our AUM, grew by 29% on a YY basis and 6% on a QOQ basis. We have added 5 branches during the quarter, with a total branch count at 220 as of September 2025. In terms of yield spreads and OPEX, the yield for the quarter is 18.01%, with an improvement of 2 basis points on QOQ basis and 32 basis points on a YY basis. Our cost of borrowing is at 8.96% for the quarter, with a reduction of 36 basis points on a YY basis and also on a QOQ basis. Consequently, the spread for the quarter is 9.05%, with an improvement of 38 basis points on a QOQ basis and 68 basis points on a YY basis. Our OPEX continue to improve due to enhanced operating leverage, and has improved again by 19 basis points on a QoQ basis and 20 basis points on a YY basis. This is in spite of a consistent increase in branch network. In terms of asset quality, our GNPA is range bound in Q2 at 2.77%, with PCR at 46.17%, with credit cost at 1.29% for the quarter. In terms of capital and return ratio, our capital adequacy ratio is 34.05%, with tangible net worth of 3,174 crore as of September 25. Our return on average AUM for the quarter is 4.56%, with return on average tangible equity further improving from 13.53% in Q1 to 14.09% in Q2. We made a PAT of 109 crore for the quarter, thereby reporting a growth of 30% on a YY basis and 8% on QQ basis. With this, I open the floor for question and answer.